So here, this is a $1 million strategy, and we are looking at the three groups in the market space. Now, when it comes under fundamentals, we have what we call the COT report, which is a report that comes out every week from the CFTC. Now, in the market, we know that we have the smart money, we have the fund managers who are the non-commercials, then we have the retailers here. Before we start, I'll explain who are the smart money, who are the fund managers, and who are the retailers in the market. So smart money, just say smart money, just say smart money. This group, they hedge against the risk, and most of the time they want to pay less for more. So let's say there's a market, let's say there's a product and it's being sold at maybe $10. If $10 is the smallest price in the market, they will buy more. Let's say, for example, when it comes to market structure, they say the most strategy that is out here is that follow the trend. So if you're a retailer, you're told to wait for the market to start going higher, and to keep following the trend. But smart money, they want to buy low at a lower cost, pay less for more. But you see when the price keeps going higher, the cost keep increasing. So it moves from $10 to maybe, let's say here, maybe $70. So here they don't like, if they bought at 10 and it's at 70, maybe they don't want to continue buying because the price has gone up. But from the retail mindset, the retailers, how do you see the market is that the more they see the market breaking the structure to the upside, the more they are convinced that the trend is very bullish and they want to keep following the trend. So what does that mean? You follow the trend, but when you don't know the value of the asset you're trading, you're paying more for less. So this is what it means. Smart money, they want to buy low when the price is cheap, and also they want to sell high when price has already gone and they feel like this is too expensive. This is the time they prefer to do it, to go short. So if it's like that, then they can say, oh, the price has gone up, this is too expensive, and let us do it, let us sell. Price started going lower. And retailers, again, they're late in the market because when it was expensive when institutions sold, everybody else was following the trend. Now that the market is going lower, maybe from 70 you're back again to like $10, then retailers want to follow the trend when the market has already dropped. So what does that mean? When the market is pushing higher, retailers are chasing the trend, but they don't know the value of the asset they are trading. When the market is dropping heavily, retailers, they chase the trend, but they don't know if price is at discount or not. Now, so we have talked of smart money, they buy low and they sell high. So does that mean they buy weakness and they sell strength? Retailers, they buy strength and they sell weakness. Fund managers or the non-commercials, this group, these are the trend followers. They follow the trend most of the time, so also they don't make money at the market tops and the market bottoms. So let's go to our tools and start now looking at how they position themselves. So let's remove this. Right. So here we'll start by bringing out our tool. This is the retailers behavior. So this is the retail net position, and if you guys want the raw data on how to calculate retailers positions or the non-commercials or the commercials, also you can let me know. So we'll hide the market there and say, if we say retailers are always wrong in the market, this is their behavior now. This is gold. And then this means that every time they are going short, look at this, they are going short, they are wrong. If they are going short, market most of the time is going to buy. So here you see they were bearish. Look at that, this is a bearish move. Here they were bearish as well. Here you can see when you see this sharp spike, like these guys are putting in short positions like this. Okay, where else? Here they were short. Here they were bearish. Okay, where else again? Here they are bearish. Here they are bearish. Even here, you can see, but I want to go with this sharp spike. So retailers, if we say they sell weakness and they buy strength, that's what it means, that they follow the trend most of the time. When the market's going down, they follow the trend. And if it's going up, they keep following again the rally. And that's how most strategists out here will say that buy, always follow the trend. The trend is your friend. But you don't know the value of the asset you're trading. So here, I've gone all the way back to 20, almost this 2015. So this is like, let's reach here. This the last one here. So this means that if retailers are always wrong, then this means that whenever they sell, the market should buy. So I've plotted this line, areas where retailers were extremely bearish, and let's see how the market was responding. So we'll bring in the market. This means that anywhere we have this vertical line, we need to see the market pushing higher because retailers are selling and the market needs to buy against them. So let's see here. And guys, this one is just a back test of our tools. See here, retailers were bearish, they are following the bearish market, and look at that, price went up. And this one is a weekly chart, so this means that one candle represents 5 days. We see more than 5 candles, that's like almost 2 months. So here retailers bearish, price went up. Here they were bearish, as you can see, price went up. Here, see, they were bearish, selling, price went up. Here again, they were bearish here and price went up. They were bearish here, price went up. Here you can see they were selling, and smart money were buying, and the market went into the upside. Here retailers are selling, as you can see here, price, market went into the upside, and here price going down, right? And like price drops, retailers get bearish, and the market goes to the upside. Look at this here, they're selling, price goes up, they're selling, price goes up, they're selling here, price goes up. And this is 2022, they were bearish as they're following the strong trend, market changes and goes to the upside. Here they're bearish, price goes up. Here they were bearish, price goes up. Here they were bearish, price goes up. And look at this, even here the bearish price goes up, and here again they are bearish right now on gold. Probably you might see gold again starting to go higher. Now that's the retailers' behavior. When they're bearish, market will go against them. Now we have I'll talk of the fund managers who are the non-commercials in this case. I want you to see this, that non-commercials, they are just trend followers. You see, they are trend followers. They go bearish when retailers are bearish. See that they are bearish. So they are trend followers. I'll say mostly if I want to get a strong signal, I look at the retailers' behavior. So in this case, fund managers and retailers, they're just like retailers. Fund managers are just trend followers. You can see here, retailers bearish, fund managers bearish, retailers bearish, fund managers bearish, and you see the market will move against them all the time. See here, when retailers were bearish, fund managers were heavily bearish, price falling, and everybody, they are bearish, like they create liquidity in the market, and the price will push against them. So allow me to say this, that non-commercials, they don't make money at the market tops and the market bottoms. Now, if you look at what we call the smart money now, let's remove the fund managers in this case. Let's remove the fund managers and bring in the smart money. Smart money. Smart money, I want you to see this, that these guys, they make money they make money. Look at this. Let's even hide the market. Let's hide the market and say, you see here they're bullish, here they're bullish, here they're bullish, here you can see how bullish they are. So you can just mark areas where they were very, very bullish. Here, bullish, here they're very bullish, and this means that they are not wrong. Like if they buy, the market will buy. Here, you can see even here, here. So anyway, I'm plotting the vertical lines. This means that the smart men are bullish on it. Here, let's put it here. Even here you can see they were very bullish. Here they're very bullish. Here they're bullish. Here they're very bullish. Here they're bullish. And let's go back to 2010. So this is 20. Come on. This 2013. Here they're bullish. Here they're bullish. Here they're bullish. This 2012. And you can go all the way. Bullish here, they're very bullish here as well, bullish here, bullish here, bullish here, bullish here. 2010, I think this is enough. So let's see how was the market responding. If smart money are always correct, then you want to see anyway they're very bullish, the market was supposed to buy. Now look at this. You can see here when they're very bullish, and you see price went up. They're very bullish here, price went up. They were very bullish here, the market goes up. Bullish here, market went up. Bullish here, market went up. They were bullish here, so the rally, bullish here, get the rally. And you can see here when they were, look at this, when they were bearish like that, here you can see price drops to the downside. Now here they're very bullish and everybody else is selling weakness and they're buying weakness, and the market went up. Here they're very bullish, everybody else is selling according to the trend, selling, and these guys are buying weakness. So we get to see here that smart money at market tops and bottoms. That you see, like here when they were bearish, here they were bearish, price drops. So here they're very bullish, market goes higher. Even you can see here they're bullish, market goes higher. And this one's the weekly chart. So you see here, look at this, they're very strong. Here they're very bullish. Here they're very bullish, and everybody else is selling. These guys were buying, and price goes up. So anyway, I've plotted this line, guys. You can see the market has been very, very aggressive, pushing to the upside. So smart money, you can slow the video, pause and watch again, and you'll see where we have those lines, how the market was aggressively pushing higher. So smart money, if you look at the current price, they're not adding positions, they're just flat. So this means that I'll not want to touch gold right now because these guys are not doing anything. And you can be able to see how bullish they are or bearish by looking at the COT strength index. So down here, this is what we call the commitment of traders report. And this one is just like if you go above the green line, you're very bullish. If you go below the red line, you're bearish. So let's remove that. And if I'm looking at the market, I can be able to see like how long the retailers, because retailers, this is the red line, these are the retailers, the blue, these are the smart money. I can be able to look back and say how far or how long have commercials been bullish or how long have retailers been bearish. So for example, here, this is like 6 months. I can show you 6 months here. Like I can say here, retailers are bearish, smart money are bullish, so gold has a high probability to go higher. And I need the divergence whereby retailers are on the opposite side. For example, here, so here, and let's just hide the market. Let's just do this. Yeah, smart money are bullish, retailers are down here. Look at this. Smart money here, they're very bullish, retailers on the lower side. Smart money are bullish here. Here, retailers on the lower side. Smart money are bullish, retailers on the lower side. Here, the same. Here, smart money bullish, retailers on the opposite side. Here, smart money are bullish, retailers on the opposite side. And let's say proceed here. Smart money are bullish, retailers on the opposite side. Smart money bullish, retailers on the opposite side. Smart money, you can see here they're bullish. Look at that. Retailers are coming from the extreme low. Now look at this. This is when this is 2018. Smart money are bullish, retailers bearish. Here, smart money are bullish, retailers are bearish. Here, smart money are bullish, retailers are bearish. Here, smart money are extremely bullish, retailers just almost bearish but not extremely bearish. Here, smart money extremely bullish, retailers extremely bearish. And here, and here, and now look at this. Smart money bullish, retailers bearish. So this we can go back, and now we're back all the way to 2013. This is enough. So let's bring in the market. This means that if smart money are always correct, where we have the lines where the smart money are bullish, we need to see the market buying because the retailers are selling the weakness. They are selling weakness, I mean. Now you can see if we bring in our tool here, we see smart money are bullish in this case. And what happened? Retailers selling because you can see the trend they are selling. What happened? Price went up. Smart money bullish, retailers bearish, price went up. So anyway, I've plotted the line. You can see some green candles there. Look at that. You can see some green candles there, showing you how smart money are always trading against the retailers. So it's not about the trend line. It's not about demand and supply. It's not about support and resistance. It's about the underlying value. So you can be able to see what the smart money are doing underneath. Then you try to align with them. That's where you see price will turn on a downtrend and go higher because smart money are bullish. Retailers are down here selling the trend. So look at this. And this just like I'm using 6 months. Look at this, smart money bullish, retailers bearish. So anyway, we have the lines. You can see price went up because retailers were selling the trend. And you can be able to go back. You can pause the video or like take it slow and watch. And you'll see everywhere we have those lines. And it's not just like 6 months. You can be able to check retailers, how extreme they have been. So let's say, you can say, let's check something like 1 year can change from like you see here, this is 2 years of data. Now, if it's 2 years of data, we want to see where smart money are bullish and the retailers are bearish on gold. So we can look at where do we see here smart money are very bullish here, retailers not uniquely bearish but away from the smart money. Look at this. Now we have even this one here, have smart money bullish here, retailers bearish, smart money bullish, retailers are bearish, smart money are bullish here, bullish here, and even here. Look at that, and can go back up to here. And let's see what the market did. You look at 1 year data, how bearish and bullish the smart money were in 1 year. You can see where we have the smart money buying, price went up. Look at this, smart money buying, retailers bearish because they sell the trend, and the market went all the way to the upside. Look at this. Here, smart money bullish, price goes up. 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 And even here, smart money bullish, price goes up. Smart money bullish, price goes up. And market kept going higher. Now, that's just like 1 year. We can be able to check 2 years. Now, this is 2 years of data, and it's the same extreme. Price goes up. This 2 years, let me go maximum 3 years, because 2 years, I think with 1 year, you see here, if you go in 2 years, you see here we are neutral, so did not give like signal here because we have gone higher like 2 years. Let me show you the difference if I go to 3 years. So this is 3 years, and 3 years it rarely happens. 3 years it rarely happens. So let's remove a chart, clean, and let's see. Look at the 3 years of data. 3 years, that's like a look back, because smart money are hedgers. So the market, if you get where smart money are bullish on gold, in 3 years time, there's a big massive move like here. Retailers are bearish. Smart money here, look at this, bullish. Here, bullish. Where else in 3 years, here, smart money are bullish, retailers on the lower side. Here, because even here we touch the green line. That one is a big move. Here, 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 here. And you can see the divergence. When the smart money are bullish, retailers are always on the opposite side. Then here, here, you have gone back all the way. This is 2012. Let's get one more. Maybe here is enough. And here. So in 3 years of data, you look at the smart money when they were bullish and retailers were bearish. Let's see how the market was responding. Look at that. Bullish, retailers bearish, green candle. Bullish, retailers bearish, big massive move. Look at that. Big massive move. Now here smart money are bullish. Retailers are just like not with them, but a little bit away, and you see some green candles there. Here bullish, price goes up. Here they were very bullish, and you see after price went lower, but everybody else is selling, the retailers down there, price goes up. Here bullish, price goes up. Bullish, price goes up. Bullish, here price goes up. Bullish, price goes up. Bullish, price goes up. Bullish, price goes up. And you can see it rarely happens. You see, like this one is 2015. It later happened around 2017, like 2 years later, and again here. See, from 2017 all the way to 2018, that's like 1 year. The price left. Now look at this. Here smart money bullish, retailers bearish, green candles. Smart money bullish, and you see price is falling. Retailers bearish, price went to the upside. Now here smart money bullish again, price went all the way to the upside, and it has not happened again. Now let's just like to see the COT report. You can also be able to look at the value of the asset you're trading, because you have to make sure that it's cheap to buy. That's why we use our valuation tools. So here, this is the valuation tool, and we have 3 indicators on it. We have the dollar, which is just the DXY, good for measuring the value of most currencies and some metals as well. We have the gold, mostly I use it to trade like silver. And here we have the 30 years treasury bond for interest rate, and it's good for trading indices now and the stocks actually. So here, let's say you're looking at the gold and you're using what you call DXY. You can say, if I wanted to buy gold, I have to make sure that it's cheap to buy. So I'll measure the value of gold compared to the dollar. Like here, when you go below the red line, it's cheap, and you should buy. Here 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 it's cheap. Here it's cheap. Where else? Here it's cheap, undervalued here, undervalued here, undervalued here. Let's go up to 2020. Okay, mistake. Okay, there. Undervalued here, and here almost undervalued, like here, undervalued, undervalued here, here, undervalued here. This is 2023, undervalued here. You are undervalued here. Undervalued here, undervalued here, undervalued here, undervalued here. For example, here 2022, undervalued here, and let's reach here. Now this means that everywhere we were undervalued, gold was supposed to buy. So let's see what happened to the prices of gold. Okay, where's it? Where's the chart? Let's pull out the chart. How far was it? Come on, it's here. You see here, when you were undervalued, you see what happened. Undervalued, gold went higher. It was undervalued, see the rally. Undervalued, the rally. Undervalued, you see it went lower. You can see some green candles here, but it went lower until here when it was coming from undervaluation, price went up. Undervalued went higher. Undervalued went higher even here. Undervalued here, we went to the upside. Undervalued here, you can see the sharp rally. Undervalued here, the rally. Undervalued rally, undervalued the rally, undervalued here the rally. You can see even here, too close to undervaluation, and we get the massive rally. Undervalued, big move, undervalued, big move, undervalued, we went up. Now here, undervalued the rally, undervalued, big move. Again, where else were we undervalued? Look at that. Undervalued rally, undervalued buy, undervalued here, the big massive move, undervalued here compared to the dollar, big massive move, and here undervalued the rally, undervalued the rally. Here we're neutral, so you're not overvalued or undervalued, so gold is going to range most of the time. Now we can be able to see the seasonal focus of the market. This is the seasonal focus, 30 days focus in the future on gold. This is 5 years, look back, seasonality, and also we use it when it aligns with the COT, then you get perfect picture. Undervalued, this was the low, and the rally was to come in here. So this was the low that was called on seasonal focus, and the rally came in. As you can see, the focus was there, focusing like we're going to get the big move, big massive move. Now you can see here, you can see when this low drop was focused to drop. Now here the low and the rally was to come in, and you can see what happened. Here the low was focused and the rally was to come in, a little bit sharp, and to go high, and you can see what happened. So for today, we have just started doing our back testing. We'll do more, and again also make sure that you trade more. So we're going to trade according to COT report, and make sure that you follow and you subscribe to our, you like the video. So I'll see you in the next series.